Hi, everyone. Thanks for coming. This is Scott Nystrom. We're very excited to have him here today.
Introduce yourself.
I'm Solomon Goldstein-Rose. I'm a junior at Brown. I study engineering and public policy. I'm the coordinator of the Energize Rhode Island campaign. If you are interested in taking a brochure, they're going around. I'll talk a little more at the end and answer questions with Scott and with Timmons. So Scott received his BA, BS, and MA from Iowa State University, and he's worked for Regional Economic Models, Inc., REMI, since 2011. He's worked with clients across the U.S. and the rest of the world in state government, provincial authorities, regional councils, consulting firms, universities, foundations, and nonprofit research groups, including analysis of the fiscal cliff, the Keystone XL pipeline, expansion of Medicaid in North Carolina, and carbon fee proposals in Massachusetts, Washington, California, and the U.S. nationally. So, all right, without further ado.
All right, thanks, Solomon. So what I'm going to be doing now over the next half hour or so before we do questions is basically publicly debuting the results of this study on the impact of a carbon price in the state of Rhode Island. What that's going to consist of is talking through what the policy actually is, defining the question. Second of all, defining the methodology. How did we address it in the way we did? And three, what are the implications that came out of the results? Real quick before I get into that, though, if there's further questions after this, if it's related to the policy or Energize Rhode Island, it's probably best to talk to Solomon. If it's related to the modeling or the results, though, I'm happy to take any questions or comments, and that's been my contact information up there for the last 5 minutes, so it should be fairly easy to find me. And that 202 number, yes, I am based on Washington, D.C., is that little cell phone sitting on the table there, so easy enough to find me. So obviously, I just want to give a couple quick acknowledgments here. Brown was the major reason this whole thing happened, so their logo is the big one on the left. There's also a couple other organizations throughout the United States that also had a part to play in this research coming about. So I put a slide in there to at least acknowledge them at the high level as well. So I'll start this from the beginning. And I'll let you all just get familiar with REMI as a little bit of background before I do that with this slide here. I work for a company that's fundamentally a software firm. We're based out of Amherst, Massachusetts. Our founder was a professor at UMass. And what we build are software models that are used to address the regional implications of policy. A lot of state governments throughout the United States use a REMI model or REMI software to address the fiscal and economic questions they have about their regions. So kind of the equivalent to what a congressional budget office does at the federal level is very similar to what we do at the regional level. And just within New England, just two very nearby pertinent examples. REMI is the model used by the Massachusetts Department of Revenue, and it's also the model used by the Rhode Island Department of Revenue to do these kind of assessments. And I know those guys fairly well. So just to show what it actually looks like, I'm not going to spend a lot of time in the actual software, but this is a very spider-webby version of it, but this is it. That black line is population. Rhode Island has approximately 1 million people. The red and the gold lines are employment. The map is correct, right? Everyone's good on that one. So yes, this is indeed Rhode Island. So this is the actual software that's used to do the thing. So our background is we were founded by a research professor at UMass. He took his research and started a software company around it, and now we're used throughout the United States to do this kind of stuff. We also work with a lot of nonprofits and all those kind of things. If anything, this is probably just the best way to show it, is each one of these little dots somewhere. I had an intern put this together, took him an afternoon. I like to show it to people to reward him for the work that he put in, is somebody who has it somewhere. And these are typically going to be state governments. They're mostly state capitals, sometimes university towns, and sometimes, of course, major cities as well. So we're pretty well known throughout the United States in this sphere for working on these kind of things. So next point is what exactly are we doing here? So this is a carbon price study. The terminology for it can vary. I've heard carbon fee, I've heard carbon tax, I've heard all these kind of different things before. We're going to use carbon fee as our carbon price as our terminology here. So the idea of it is there's going to be a fee paid on carbon dioxide emissions somewhere in this energy supply chain. I'm not really a specialist in implementation, but I do want to make a little bit of a note to it. And this will be a consistent important point throughout the rest of the presentation, is according to all the federal data I've looked into, is Rhode Island has no extraction of natural gas or petroleum products and no coal mines and no refineries. So the back-end production level and processing level of the fossil energy supply chain does not exist in the state and the region. As far as I can tell, the closest refinery is in the Philadelphia area. So
Used to have coal mines, but they're closed.
yeah, so nothing current. A lot of states actually did. Like Minnesota actually used to have a lot for that matter. Not anymore. So carbon pricing, the idea is it has two objectives. One is to disincentivize the use of fossil energy products by increasing their price. It's cause a price incentive or a price response. The other is, and this is that's oftentimes missed in these discussions or these analyses, is it generates a significant amount of revenue that can then go towards other policy purposes. One of the most important of those purposes is compensating or adjusting for those higher prices that we came about in the first place. So those 2 points dovetail with each other. Implementation-wise, like I said a second ago, because the state really doesn't have much energy extraction or processing, you can't tax it at the point of extraction or import, just practical-wise. That's maybe something that could be done internationally or nationally or continentally. So you'd have to tax it at more the wholesale or the retail level, at least at a state like this or somewhere in New England. There are precedents for this throughout North America. Probably the most obvious one is the carbon price, carbon tax in British Columbia, which has been in since 07 or something like that, 08, something like that, 08. So getting close to 10 years, it's 7 years old now. There's semi-comparable systems. It's a different mechanism, but cap and trade systems, RGGI in the Northeast, as well as AB 32 in California, which is slowly getting off the ground. So this is basically taking, to a large extent, the British Columbia idea and applying it to a state like Rhode Island. Okay. So here's the actual policy. This is, as it currently stands, it's my understanding this basically is the bill. This is actually it. This could always change in the future. The general lessons I'm going to be discussing still track the same, though. So the idea is, first we put the price on it. It's $15 the first year. That's the first dot. And then it's $5 per year in every subsequent year to 2040. The models we have cut off at 2040, so that's the end of our analysis. Just to give a little benchmark here and what kind of price effect and what sort of incentive this injects into the system, the little rule of thumb out there is that $1 per metric ton, so $1 on that left scale over there, is about 1 cent per gallon of gasoline, roughly speaking. So $15 a ton is about, it's a little less than that. It's about 13, 14 cents per gallon. And just standard rule of economics, if something's more expensive, with some very rare exceptions, people buy less of it. This is incentivizing people to consume less of it, whether that's through efficiency, behavioral changes, utility upgrades, infrastructure upgrades. It's all of the above. You take that money, though. So imposing higher energy costs on any economic system has a negative effect by itself. That's absolutely true. And theory, practice, all the models have that kind of stuff. So it has the negative side there. But interesting little factoid, 49 of the 50 states of the United States have a balanced budget amendment. The first one to actually get one was Rhode Island in the 1840s, so it's had one for quite a while. The one state that does not is Vermont, but they do it every year anyways as a matter of best practice. So states exist in a fiscally constrained environment. They're not like the federal government. They can't dump things onto a deficit. They have to pay for themselves. There's some limited things they can do in the short term, but fundamentally they have to pay as they go, which means that this money, as it would come in from this carbon price, would go someplace. And we divided it out here between these 4 different options. One is a dividend check to households. This idea is taken from Jim Hanson's proposal at Citizens Climate Lobby, where basically every Rhode Island citizen would get a check for breathing, just for being a resident of the state. So basically you get money just for being in the state. There's actually one state of the union that already does this. Yeah, the Alaska Permanent Fund. Funny thing is, Alaska, very different state politically. It has a huge energy production sector, and it's a huge energy exporter. So kind of the cardinal opposite of Rhode Island when it comes to the energy sector. But they have a royalty. So you take it out of the ground, you have to pay a tax on it, which then goes into a sovereign wealth fund, which is then rebating its interest and its dividends every year to Alaska citizens just for living there. It's not called a carbon price or a carbon fee, but you could convert it into an equivalent one very quickly. So Alaska's kind of got something like this already going on, which is an energy production state. So that goes to households. That's 40% of the money. 30% goes to employers by their share of state employment. So Rhode Island has a corporate income tax, as do most states. And we looked into this, and of course, one thing you could think you could do to compensate businesses for higher energy costs is cut their taxes. And we do want to reduce their costs, but the thing about a corporate income tax is it only covers certain enterprises, it only covers certain employers. State and local governments use a lot of energy and they're big employers, but they don't pay taxes, or at least they don't pay income taxes. Nonprofits, particularly in this state, this university being a good example of that, they're big energy consumers, but they're also big employers, but they don't pay taxes because they're nonprofits. Same with a lot of hospitals, particularly in New England. Also startups, self-employed, one-man proprietor shops, S-corps, all those kind of things. A lot of times they don't pay corporate income tax. So to do something for them, this is the alternative. Basically, every business has a share of state employment. If it's a big employer like Brown, it might be a couple % of the state's employment. If it's a small, little retail establishment that has 2 employees, then it's a very small percentage. They get back 30% of the money based on their share of state employment. That way you hit all sectors, and you hit the nonprofit sector, and you hit the government sector, and you also hit even for-profit businesses that don't have a corporate income tax liability because they didn't make any profit last year, or because they had so many deductions or something like that. 25% goes to state efficiency and weatherization programs. So this is not revenue neutral, this is spending. This is going into state programs to improve energy and process efficiency. And then there's a 5% assumption about administrative overhead. I actually think that's probably high, just giving an example of this. This is national, but not, I still think it's applicable. Internal Revenue Service processes about 250 million tax forms per year, and they're working on them right now, obviously. So 250 million. Their annual budget is about $10 billion. For $10 billion, they bring in trillions. So their actual overhead cost is way less than 1%. Granted, that's a very different program. It's a different economy of scale because it's federal, but 5% is a really, really, really high margin reserved for administrative and overhead costs compared to every other tax in the United States, both state, federal, and local. So that's the policy. Every result you're going to see throughout the rest of this is based on that price and then that revenue going to these purposes and these shares. I could look at other cases, and the report has 4 of them. One that is more true revenue neutral, one that puts a lot more funding into weatherization, and one that puts a lot more into research and development. But this is the one we're going to concentrate on right now because this is the way the current bill is structured. So methodology. There's 2 models here. I'm not going to go through all the technicals of it. I'm just going to explain the concept. So one's called CTAM, which is kind of fun. It's also free. You can find it online. It's Excel-based. It's worksheet-based. And I've used it in Mass twice, Washington and King County, which is Seattle-Bellevue, so it's the big county in the state. It's the equivalent to Suffolk County in Massachusetts. California, I modified it for the federal. There's certainly different things you need to do at the federal region, and in Vermont. And what it basically does qualitatively is what an economist would call price elasticity of demand. And when speaking English, what that means is people are sensitive to higher prices. Just how sensitive are they? Gas prices pretty routinely fluctuate, and they certainly have in the last 6 months. And people will buy more or less gasoline as a consequence, but just how much more or less? Are they price insensitive? Is it a good where a small change in price causes a very, very quick flight to alternatives, or is it good where people just kind of tend to pony up and pay? This presumes they're all pretty much inelastic goods. That is, people are resistant to consuming differently, but not entirely so. And I don't have this graph in here, but this is all based on econometric research, but there's this fun little graph I saw of light truck as a proportion of automotive sales versus gas prices. Light trucks and SUVs tend to sell much, much better in the winter because gas prices are lower, and they tend to not sell nearly as well in the summer when gas prices tend to be higher. It's almost a perfect inverse correlation. One goes up, the other goes down. I don't have that graph, but that's what this concept is. As the price goes up, how are people going to cut back and change their priorities of spending? This thing here, and I promise I won't quiz you all on it later, is the actual economic model. So all these little boxes are concepts, and all these little arrows between them are equations that link them into each other. Some of these are pretty simple. So look on the left side, kind of 9 o'clock. Population times participation rate is your labor force. If you have 50 people, your participation rate is 50%. You have 25 people in your labor force. So some of these are very simple multiplications. Some of them are much more complicated econometrics. There's a few matrices in there. So that's the actual quantitative model that the states use to do fiscal and economic research. The blocks going through them, block 1 at the top, state government plus investments plus exports plus consumption, it's GDP. It's just the macro economy. It's the economy as a whole. Block 2, it's a really funny label and capital demand. So most of you in here have had jobs, or you will have jobs throughout the rest of your life. When you have a job, what you're really doing is selling labor, your labor supply. So somebody is buying that, and who buys that are employers and businesses, firms, enterprises, entrepreneurs, whatever you want to call it. So that's what block 2 is, the firm perspective. This is businesses hiring and investing to do production. Block 3 is demographics. REMI's as much a demographic model as an economic one. So that's underlying population change and also migration within the United States. Kind of a little aside here, but one reason that unemployment rates in the United States tend to be lower in the long term, like natural unemployment rates, than they do in Europe, is because in the United States, you don't have to ask for a permit to change states or change counties. So just out of curiosity, who in here was born in Rhode Island? Just hands up. Anyone? Literally nobody? One person. So all of you came from someplace else. Why? Personal reasons, lifestyle reasons, but probably a big determinant of that was the labor market. So because European countries, it's better now with the EU, but in the past, it was really hard to move from one European country to the next, so their unemployment rates tended to persist. Right now, if you're a young Spanish or Greek or Italian, you would really probably should move to Germany or Sweden or something where the economy is much better. It's just much more difficult to do that, unlike in this country where people have tended to leave Michigan and Ohio and go to North Carolina and Texas and the like. So that's inside the system. Block 4 is equilibrium concepts. So this is market concepts. You can see on the left, employment opportunity is jobs, compensation is wages, housing prices and consumer prices is cost of living, business costs are over here, which all leads to block 5, which is market shares. One point plenty of people do make about a carbon price, and it's a completely fair point at the state or the regional level, is this might put businesses at a competitive disadvantage relative to their neighbors, both regionally and nationally and internationally. One of the main purposes of this model is that block to determine how much trade flows, market shares, competitiveness will change. So when we do something to electricity prices, it will affect businesses' competitiveness, but you have to think of it in net terms. How much of their cost for energy goes up versus how much their cost for labor goes down. That's what this is going to net out for us. These two integrate with each other. You take the price and energy data from CTAM and you put it into PI Plus as variables, and PI Plus adds some forecasting of GDP and population that goes back into CTAM. So they work in concert with each other. So with that, I'm done with the background and the methodology. Now I'm going to talk about what exactly it said and what about exactly we found. So we'll start with employment, everybody's favorite. You actually have more jobs in Rhode Island relative to a baseline, relative to a do-nothing, relative to just business as usual, than you would have otherwise with this policy. And it's about, you can obviously read the scale here, it's 2,000 to 4,000 jobs. For context, like I said a second ago, Rhode Island has about 600,000 jobs. So this is less than 1%. It's a relatively small impact, but it's still a positive impact. There's two main reasons for it, which I'll get to in a second. I've already kind of told you one. But before I get to one of them, I want to show the gross state product impact. So this is GDP. It's just the state equivalent, GDP at the state level. As I said a second ago, because Rhode Island imports most of its fossil energy commodities, that means money's leaking out of the state. Now, every state has some local fuel distribution and retailing, be it fuel oil, gas stations and the like, and the model accounts for that. It knows that there's retail and wholesale markup locally for these sectors, so it knows that. The number I usually see cited, though, is that about 75% of the value of a thing of gasoline, which is the big one, obviously, about 75, is the product as it leaves the refinery. So that would be the value that the state does not capture. So every time somebody fills up a gas tank, say they spend $20 on it, 15 is leaving the state. It's going to refineries in the Delaware River, it's going to refineries in Texas and Oklahoma, it's going to crude producers all throughout North America. North America doesn't really import crude much anymore, but there is still a little coming in from places like Venezuela and Nigeria, not so much Middle Eastern anymore. So it ends up someplace else that's not Rhode Island. From Rhode Island's perspective, that's a loss. It's a very, very standard economic development strategy throughout the United States to displace imports. to make it yourself rather than getting it from someplace else. That way the dollars and the jobs stay local. As a consequence of disincentivizing this stuff being consumed, it's not made someplace else because people aren't buying it. It decreases imports. It increases GDP. So one reason jobs goes up is simply by displacing imports. That's $200 million kicking around in Rhode Island's economy. Translated into the labor market, it's a couple thousand jobs. Again, this is all within 1%. These are all relatively small impacts, but it is still a positive impact. The biggest one, GDP-wise, is displacement of imports. Oh, I already had a graph here to do percentage changes. This actually leads me into my second reason. So notice that the impact of employment in percentage change and proportional change is better, quote unquote, than the impact to gross state product. So you're getting more jobs relative to how much output you're getting. This implies that the economy is relying on labor more heavily than it would have otherwise. In theory, these should move with each other, but they're not. And the reason for that has to do with industry mixture. So look at this one here. This is the average year. This is just the total and then averaged out, so it's the average year for the whole time period. The impact on employment by industry over time. So notice that all the industries on the top, especially construction, construction's basically directly receiving, because that's the industry that does retrofits and weatherization. That's the industry receiving about 25% the money. It's also a support industry to just about everything else. Almost every industry there is requires space, just square footage. Like Brown requires somebody to build this building and maintain it over time. So construction's behind everything. As you can also see, all the industries at the top, they tend to be relevant to consumer spending. They tend to be localized. There's stuff that doesn't get exported. There's stuff that doesn't get outsourced. They can't be in most cases. They're mostly services. And they're also industries that Rhode Island pretty much depends on anyways in the first place. The biggest industry by employment in the state, actually those top three after construction, like those four at the top are the four biggest employers in the state as it is anyways. So this is transitioning away from buying a product that is not using much labor and is produced someplace else to now people just spend the money generally when they get the rebate checks, and they're going to spend it on the things they do that are localized and labor intensive and Rhode Island specific. That's the stuff at the top. There are a few jobs shed down at the bottom, but again, 37 jobs in utilities, transportation, those are relatively small impacts. The net across all industries is positive for the numbers that I showed you a second ago.
That mining number, I mean, I look at numbers like this, and I've dealt with you guys in the past, unfortunately. That mining number, it's an absurd number. How do you get a loss of 2 jobs in a year? I mean, how does that, justify it?
It's presumed to be close to zero. Again, these numbers are all, it's a math model, not a stat model. It solves to the whatever 10th decimal place, because again, it's a mathematical system. Don't interpret it too literally. It's -2. In all reality, if I'm talking statistically, it's 0. There are some mining jobs in Rhode Island, by the way. They're mostly rock quarrying and the like, which is an industry that has some employment, uses energy and all that. But again, I call that 0. And frankly, a lot of these, Rhode Island is not the smallest state economy, obviously. You are bigger than a couple other states, your smallest land area. But I call it basically 0. Same for most of the stuff towards the bottom. When you get stuff that's over 100 or over 50, now you're talking about a couple businesses in each industry, then it starts becoming, relatively speaking, appreciable. So here's output by industry. Same basic pattern where it's all those localized service-intensive sectors that are at the top, especially construction. You get down towards the bottom, though, there are a bit of loss in utilities. Utility is almost all entire power generation and distribution. This one's a little bit misleading because there's only one power distributor in the state, and that's National Grid. They're not going to change the amount of infrastructure they have, or really to an extent how much employment they have. They're just going to run less juice over the wires as a consequence. They still need to have the same system. Same for gas distribution and the like. It's just they don't sell as much of it as a consequence. It's just part of what they would consider conservation. So that's just an expected result. Manufacturing, 24 million. Nobody wants to see that, but I think that's a little misleading, which I'll talk about in a second. But as I said, it's the same industry mixture. There's a few sectors here that have very small, less than 1 or 2% losses. There's a lot of others that have very small, 1 or 2% gains. As a consequence, the state economy is some fraction of 1% larger. So here's manufacturing, looking at that industry specifically. The point I'd want to make about this is if you take out chemical manufacturing, which uses, again, petrochemical feedstocks and the like, it's zero. Like all these other ones net out to zero. They're all very, very close to zero. $1 million or two for a lot of these industries is not a very appreciable impact, all things considered. So there's one industry with a slightly negative impact, but this is a pretty large industry anyways. Chemicals in New England actually tends to consist of a lot of pharmaceuticals, maybe more so in Massachusetts than in Rhode Island, but it's a relatively small impact again. That's where most of that impact is coming from, that industry. So now let's do the impact on households. First of all, people might bring up the point about cost of living. What does this do to Rhode Islanders trying to make it through? The price index we use in our system includes a lot of different things. It's basically everything you might buy. So any given household, generally speaking, their biggest expense, their biggest cost is housing. After that, generally speaking, it's healthcare. They may not realize it because their employer's buying their insurance for them, but it's part of their compensation. It's part of their cost if they realize it or not. After that, typically what it's going to be is usually durable goods. I'm talking like furniture, vehicles certainly, but a car that lasts many decades, a decade or two is much different than fuel that is consumed instantaneously. Furniture is factored in there. Education starts creeping in there pretty quickly. Then you start getting into food and entertainment and all these kind of different things. And eventually you do, of course, hit energy. It's in there. Even though this does increase the cost of energy for states, if you benchmark it against everything else, including housing and healthcare, which not all cost of living indexes include, which is, I think, a mistake because that's the biggest part of it, to be honest, it's about 0.5%. So if inflation's 2% a year, which historically that's about what it is, this means that you have 3 months of extra inflation between now and the 2040 than you would have otherwise. So a very small change over multiple decades in this case. It's appreciable. You can see the numbers here, but again, this isn't 20 years. You put that into income. So real income is income that households are getting divided by cost of living. So it's a real income. It's accounting for the price change. It knows that the energy costs have gone up. It's still increasing real income in the state by $80 to $100 million. Again, less than a 1% impact, but it is still an appreciable and a positive impact to the state. Again, mostly because an imported product is not being bought as much and the dollars are staying local. And actually, kind of fun little final result here, I thought was just kind of, I don't want to say cute, but this actually, because the labor market's stronger, it draws more people into the state over time. Though this is kind of deadened to an extent because there is a higher housing price. There's a fun little section in the report. It's only 2 pages, but I think it gets the major issues out. Rhode Island is the 4th most open economy in the United States. 1 is Jersey, 2 is New Hampshire. Everybody in southern New Hampshire works in Boston. 3 is Maryland, which is the Washington, D.C. thing, and Baltimore's not that far from Philly. 4 is Rhode Island. So you're a very open economy. Part of it's you're just small. Part of it, of course, is Providence is right up near Boston, and then the eastern part of the state and Massachusetts pretty much flow over each other. So it's pretty easy for people to live on the Massachusetts side and work on the Rhode Island side and vice versa, though in general it tends to be cheaper here than it does in the Boston area. So this does deaden the population effect a little bit because people could crowd around the state, but even then, being close to work is just fundamentally attractive to most people. So there's 4,000 jobs. Some of those are taken up by Rhode Islanders, but some of those are taken up by new Rhode Islanders. They move into the state as a consequence of a stronger labor market. They settle down, they buy houses, they contribute to the construction industry in the long term, and it increases the state's population. So now I'm going to go into the kind of tax and budgetary implications of the same. So this is not out of PI+, this is not our model, this is the outside stuff, but it's still interesting. So here's the actual revenue this generates. This is the static, if you're relying on kind of standard tax terminology. It's hundreds of millions of dollars per year. State of Rhode Island's budget's about $3 billion, so this is an appreciable percentage of the state's budget very quickly. But again, we've already dedicated the money in that pie graph from a couple slides ago, so that's where all this money is actually going. And then emissions. I'll make the kind of disclaimer that I have no opinion on climate science. It's not really my field, and the type of modeling I do doesn't include that. This is purely a tax study. If anything, the way to think about it is most federal funds and most state funds in the United States come from an income tax. And the reason we have an income tax is kind of a historical accident. We had one during the Civil War to pay for the Civil War. It was declared unconstitutional and gotten rid of. We got another one in the 1910s to pay for the First World War. They passed an amendment to make it legal, and we still have it. Most economists would probably not think that an income tax, all things considered, is an efficient, because it discourages work and investment, or an easy way to set up a tax system, but it's what we have. Same idea here, is this is what we want to have. The motivation for it is kind of a byproduct of the same. So we're just taxing a commodity inside a system and seeing what happens. So on the left are emissions. The gold line, baseline, is what EIA, it's the federal data, says that it's more New England than Rhode Island necessarily, but the patterns are relatively speaking the same. The state's emissions are supposed to gently decrease, but then stabilize at about where they are now. There's basically no change. You put in the price that I've described to you, though, and you can see the blue line starts happening. You put that against this percentage scale of 1990 emissions. So it's Kyoto Protocol. 1990 is pretty arbitrary, all things considered, but it's what's used. And you can probably ask Solomon about this, obviously, but there's some goals here. So that red line about where it gets to it. Doesn't quite get there, obviously, but it starts coming close, and it maybe diverges a little bit in the outer years, but it certainly makes progress towards that red line if that is your stated goals. So that's pretty much it in terms of results. Just to give you 4 high-level summaries, like I said, the economy's slightly larger and has slightly more jobs. The main reason is displaced imports and, to an extent, a more labor-intensive industry mixture. Using incentives to change around people's preferences to where they buy more general consumer goods and less fossil energy is more labor-intensive and localized. Fiscal, it's a lot of money. Just it is, let's just say that. They're actually fairly stable because these are inelastic goods, but it's a lot of money. Emissions, I'm not going to comment on that, just let that one stand for its own. And then just my own little cutesiness here is the gold thing at the top makes the labor market stronger. Jobs draw people, so it actually increases state population in the longer term by a few thousand, so a couple more towns maybe, people in the longer term. And then just my last kind of slide up here, I'd leave on this, and I've simplified this from the national study. But for a long time, environmental and energy policy has been always done kind of through just pure trade-offs, particularly at the federal level. And in a lot of cases it can be, because you're just relying on regulatory issues and kind of legislative fiat. You're not using incentives, you're just mandating, where that can actually be the case. And sorry for this little thing here. Boy, okay. Where if you're just imposing costs on a system and you're not bringing revenues out and using them for other purpose, you can actually harm an economy negatively. But because this becomes a fiscal issue, and because Rhode Island, again, is that importer, it doesn't have the localized industry, in theory, I guess you could say that this is reducing output in an oil exporting state or an oil exporting country, Canada, Texas, and the like. From Rhode Island's perspective, it's not necessarily a trade-off. It can actually be pretty neutral, if not positive, for the reasons I described. And the last point I'd make here is there's no climate concept in here. These results are purely we're taxing something and we're returning the money in the way we described. There's no climate feedback. None of these results depend on sea level rises or frequency of intense storms or water availability in the western United States, whatever it is. Again, I don't know that much about it intentionally. It's budget reform. We're taxing a commodity. We already tax a couple other commodities. Like, why in the world do we tax with a sales tax magazines but not dental appointments? They're both transactions. They're both things consumer buys. We just do. Same thing here. Emissions is purely a byproduct. There's no externality effect. There's no Pigovian effect or anything like that. This is just an extra result that comes out the models. To be honest, the carbon is frankly interesting to the modeling here, mostly to figure out how much revenue comes in. The emissions effect that I showed you are just a byproduct of that. So with that, I'm pretty much done with the main stretch of this, and I guess we'll all down here kind of take some questions. So thanks.
Cool. I'm actually going to have to run out in a moment, but if anyone has any questions specifically for me, ask them quickly now, and then Scott and Timmons will still be around.
When do we have the room until?
6. there is another group after us at 6.
Just
so we'll have
6.
to be out of there.
We have
then.
like 5 or 10 minutes.
But I assume you guys are willing to stick around after that. And
Yeah, we'll
talk
be
with anyone
outside.
individually.
And if anybody needs to dash, I've got a ton of cards in my jacket. Just ask for one.
Yeah. We have a bunch of materials here. There are brochures there.
I'm gonna put
There's
these
a
over
campaign
here.
that's working to pass this. There's an FAQ sheet, and there's the actual bill that we are proposing. And then there's also the summary, including basically these last 2 slides. Yes?
What is the status of the bill right now?
The bill is, there was a previous version introduced and then withdrawn in both houses, actually 2 different versions, and now we have come with a new proposed bill. And we're in contact with several representatives who may reintroduce it this session, but more likely it's going to be a big push to pass it next session. Yeah.
Could you talk a little bit more about how the, the household payments, the payments that go out, either householders to the employers or for the weatherization, how do those feed back
Sure.
in through the model and
Sure.
the impacts?
Sure. So, like you said, there's 4 categories of how the money is used, and I'm going to use this just flowchart-wise. Heck, I'll do the cost side as well, for that matter. Higher energy costs for businesses become their cost of production. Their cost of production is going to affect their competitiveness. For households, it becomes part of consumer prices, which affects real incomes. So if the price index, the cost of living goes up, everybody's real wealth has gone down. You have the same amount of dollars, but they don't buy you as much. So that's the negative side. Positive side is the rebates to businesses go into their cost of labor because it's a rebate based on their employment. So they're going to have higher energy costs but lower labor costs. I'm not going to say everybody's going to be, theoretically equal and it'll be different by firm and industry and all that. But theoretically, the concept is those two. It's meant to give those some balance. The rebate to households, it's the top right. It goes into real income, disposable income, and then into consumption. The theory is that they're going to have a higher price index, but they're also going to have more income coming in because of the dividend. The two should equal out, roughly speaking, in the end. That is, you'll be buying about the same because you'll have more money coming in because of the dividend, but stuff costs more. So they'll roughly equal out with each other. The weatherization is vectored essentially to the construction industry. That just goes straight into output and employment for that industry, which is the industry that actually does that type of work. And the administrative overhead is put into state and local government, assuming that that's where the actual administrative apparatus for something like this would be.
Just to note that if there's extra money that is not spent for administration and overhead, it would go to the weatherization program.
Okay.
So, if it is closer to 1%, then the weatherization would be 29% instead of 25%.
Yeah, and I don't know what it would cost, to be honest. The obvious analog's British Columbia,
Yeah.
and I just haven't looked, so I don't know what it would be.
So you're following the legislation.
Yeah.
How about a question or two?
And does the weatherization program depend upon a state program, or are you counting on entrepreneurial?
You guys want that
The
one?
way the legislation is written, we would have that fund going to well, you can correct me if I'm wrong, but the intention is that it would go to the new green bank or infrastructure bank, which would then distribute it. It would be through existing programs for weatherization and then maybe some new ones. Most of them are done by private contractors.
Yeah.
In fact, I think they all are.
In my system, it is basically assuming that it ends up in the hands of private contractors. The government spends a lot of money, but frankly, not a lot of it's actually government. A lot of it's contracted out to various industries. In this case, the various industry is private construction contractors.
Yeah.
Does the model account for people going outside the state for their hydrocarbons, like going to a gas station in Massachusetts?
More or less, yes. It does allow cross-border shopping. It also, maybe more importantly, you're right that, okay, so maybe some people on the margin are going to move their car and buy gas and come back, or change out where they're filling up on trips. It also, though, accounts, and this is actually the bigger one in the long term, for people relocating their entire household, because it's not just gasoline, it's fuel oil, it's everything. Frankly, people maybe refilling over the border once or twice a year, or maybe even 20 times a year, is not that much money compared to an entire household that might make 50 to 100 grand, moving their entire house onto the Mass or the Connecticut side. So, yeah. It accounts for both of those.
Is there any way that you could, if you live near the border, contact the fuel oil providers other than
That's also still part of the thing. Though that might be something the bill could essentially address.
Yeah, we talked about having, like, for example, if you have an appliance delivered to your house, often the taxing is done by where it's delivered. So we would have the fuel companies have to pay for the taxes delivered to the state. We also, though, considered having a provision, we've gone back and forth about this, about having this not come into effect unless Massachusetts has a similar level of price on carbon. For a lot of these same reasons. I mean, we are really right up next to each other.
And I'll make the point too, is I ran this just Rhode Island by itself, and then I put the same thing in Mass just to see what it would look like. It actually is better for Rhode Island if Mass comes along. This is still positive, but it's even better. The reason for it is, as I said a second ago, Rhode Island's got a really open economy, and it's almost entirely open towards Mass. That's like it. A little bit Connecticut, but it's almost all towards Massachusetts. So if Massachusetts, which is 10 times the size of you all, 9 times, but 10 times the size of you all, does the same thing where it's importing a lot less fuel oil and its economy gets bigger, that spills over into New Hampshire and Rhode Island. It's all one big metro area from Providence up to Manchester, really. So actually it's more positive if at least eastern New England does it at the same time. And there's a part in the report that discusses that.
We have time for like one more. Yes, sir.
So Rhode Island is piggybacking off of Massachusetts. How far along is the Massachusetts process?
Yeah, they introduced a bill last year. I don't know how far it made it. This year it's in both chambers and it's once the legislature is, I guess, co-sponsoring. So they're further along, I think.
Their hearing date is coming too. I noticed in some of the things I read, there's
Yeah.
an estimated April or May hearing date for Rhode Island. Is there a date established?
On their side?
No, on Rhode
On ours. No, because our pieces of legislation have been withdrawn this session, so it'll probably be, for us, we're probably looking at next year.
Yeah. Okay.
Do you have, when you make the model into the future, do you assume that it's the same amount of energy, or do you have, say this is successful, do people use less energy? Does it account for that?
Yes.
As you go forward?
Yes.
How much does it take out of the, whatever that,
You saw the emissions.
the emissions thing
Yeah.
came down, so it uses that?
The emissions is derived, you have the other way around. The emissions is a result of how much energy is consumed. Basically, the way it works is it's modeling how much people use of fuel, and then I'm just making a pretty simple multiplication. A gallon of gasoline weighs 6 pounds. You burn it, it weighs 19 pounds of carbon dioxide. That's just the calculation there. So yeah, it accounts for that stuff. People buy less of this. They have to pay more for it, but they're buying less of it. They're getting the money back in the way I described, and they'll just kind of treat that as part of their general consumer income.
So one more question, and there are also some postcards up here. If you're interested in getting more information and being part of this effort, please sign those, put your name and address and email and stuff. We will keep those, put you on a list if you like, to get updates on what's going on. If we have a miracle happen this legislative session and we end up back being considered by the legislature on this new version of the legislation, we will certainly let you know. So please leave those cards if you do those, and then we can give them to legislators to encourage them to move on this. So the final question. Yes.
For the carbon emissions, does it take into account the population growth that will happen?
Yeah. Rhode Island's long-term population, you saw that black line like really early, it's pretty flat. New England's old, it just is, and it doesn't get a lot of in-migrants because it doesn't rate as very attractive, all things considered, compared to like the southern states where it's warm, and it's not like that very much. And also, the land use and housing, the land use constraints in New England are impressive. It's not like the Midwestern or southern states where you can just keep adding housing stock. You're kind of out of space around here. There's some, but it's harder. So yeah, it accounts for it, but it's accounting for basically stability, not increase. If you were looking at Utah or Arizona or something, you'd be definitely adding a lot of people.
So I want to ask you to join me in thanking Scott Nystrom for an awesome
Thank you.
study.